Hi, and welcome to this week's look at the major stories that have affected the market so far and moving forwards. And we're going to start with the Great British Pound. Many of you will know we had the coronation of King Charles III on Saturday, and he certainly seems to have given a little bit of a fillip to the Great British Pound. So the coronation was Saturday, but on Friday we saw the pound hit the upper 1.26 levels against the US dollar. That's the second highest value versus the dollar in over a month. It's still around the 126 mark now. Now, Monday's 12-month moving average was the highest in over a year. Now, this is despite double-digit inflation in the UK versus what was at that time 6% inflation in the US, which has actually fallen even further, down to 4.9% this week. And we've got the cost of living crisis and high borrowing costs in the UK at the moment after all the increases in interest rates. So why? Well, obviously, you've got to look at the dollar as well here. So the weakness of the US dollar due to the threat of default is certainly there. Janet Yellen, after came out last week and was talking about the fact that the Fed may run out of options to avoid the default. The banking crisis seems to be going on a little bit longer in the US than anywhere else. An UK interest rate decision Thursday could well have an effect as well, but most people think that's pretty much priced in. Now, going forwards, obviously that interest rate rise potential in the UK, but probably more importantly, the commentary that comes out from the Bank of England around that. And let's have a quick look at the chart. We see a 1.2666 was an important peak on the chart in May 2022. That's probably pretty much going to be around now as well. Fair to say though, volatility in this historically stable pair continues, and moving forwards over the coming days, weeks and potentially months, I think we're going to see a lot more volatility and a lot more movement in this market. Okay, so we're seeing some strength in the Great British Pound the last few days, and that seems to be staying where it is. But the FTSE has fallen despite the pound. Now, if you wanted evidence that the large cap blue chip companies listed on the FTSE 100 are not influenced to any great degree by the highly liquid currency markets, then this week's performance pretty much provides that for you. So despite that sudden increase in the value of the pound at the end of last week that's holding on to this week, the FTSE 100 has lost over 170 points in the last week, currently below the 7,700 mark as I speak. If we look at it over a longer period of time, February the 20th, we saw 8,001 registered during the day. March the 15th, 7,335. So we're sort of in a range between those figures. And many analysts are laying the blame at the generic interest rate increase that were expected today, Thursday, by the Bank of England, but the pound seemingly ignoring that issue currently. There is market talk of sterling not being as unattractive as feared due to Brexit and the fact that we're getting sort of further and further away from the initial period of Brexit. The slowdown in growth of the Chinese exports has also been mentioned, though again, that doesn't seem to hit the Asian markets to quite the same degree. So it does appear as though a lot of this has been sort of laid at the door of interest rate increases, and what's going to happen after that announcement, who knows? But as I mentioned before, a lot of it may well come down to the fact that we're expecting 25 basis points, but what is going to be said? What's going to be the talk around it from the Bank of England? As we see, FTSE not reacting the same way as the pound, not highly unusual, but certainly a divergence worth keeping your eye on. Okay, so third up, now we've obviously taken quite a look at the UK there in terms of the pound and the FTSE. But what about across the pond in the States? And in fact, the S&P 500 reacts very positively to that decline in inflation rates that I touched on earlier. Wednesday brought us news that the US CPI fell to 4.9%. In fact, the last time the CPI in the States was below 5% was back in May 2021. So clear indication that the Fed's tightening policy, increasing interest rates, has had a positive effect. Market participants now expect a halt in these interest rate rises. I think that's fair to say, although the Fed a little bit guarded around their language in that sort of principle. But the S&P reacted positively, with futures rising and approaching the 41.70 resistance level that's been in place for some time. Has eased off a little bit since then to around the 41.30 mark, but what's going to happen moving forwards? Well, analysts at UBS, for example, say the price will be flat. Analysts at Morgan Stanley say US stocks will decline as the possibility of the economy entering a recession is still there. And of course, there is still talk of a credit default. These are analyst expectations or analyst views. Clearly, the S&P's having a pretty good week. But that 4170 mark may be a step too far. And that resistance, if we look at the chart, has been there for quite some time, may well be evident as we move forwards. CPI going down is no doubt a very, very good thing for the US. But these other factors, the recession, credit default, are in play. It's going to be one to keep your eyes on. Will we see a resurgence of the US stock markets in the coming months? Many people hope so. Okay, so finally this week we're going to look at an individual share. We've done a little bit of industry stuff and a bit of currency, so why not? And will Amazon hit last month's highs again in May? Now, stock's been pretty volatile over the last few months, probably a little bit more volatile than we used to for a major big cap US stock. What's happening short term? In the previous 5 days, we've seen an increase of about 2.86% in the share price. If we look a little bit further, April the 27th, we saw it jump during the day to $109.82 a share, and then fall off quite rapidly back down to $102.05 per share. The last 2 weeks have been brighter. In fact, a month ago, the share price was below $100, currently trading around the $110 mark. So looking positive on the short term. Obviously, if we look over a longer term chart, we should always look at varied timelines, really. It's not quite so attractive. But why now? What's happening at the moment? Well, about a week ago, Amazon announced a new set of services for advertisers across a range of different digital channels. Amazon Prime, already in existence, but they brought out some others. There's Thursday night football coming out of the US, for example. Now, what this does is show that they're trying to drive a large increase in ad revenue. Now, they obviously already get a large portion of their revenue from advertising. It is a mainstay for them and something that is attractive for investors in the longer term. This is also a long-term view because these channels won't actually launch until next year, 2024. The market's reacted well to it quite clearly, and it's possible this could drive the price increase in coming weeks and months as well, because longer-term plans and strategic, stable growth plans are what appeal to a broad spectrum of investors. And when we're talking about large cap, top of the tree stocks, that's what they require. A real breadth in terms of spectrum of investors, as institutional and wealth managers, proprietary funds, family funds, all the way down to the individual private investor like you and I. So the outlook for Amazon, based on what they're saying here, and some other announcements they actually made as well, is looking pretty positive. But of course, we have seen that volatility in recent months. So as ever, when it comes to volatility, don't forget your risk management techniques. And we wish you luck for your week ahead. Bye for now.